Okay, hey YouTube. This is going to be just a really kind of detailed overview of everything I've gotten from learning about day trading the last 2.5 years. So, I'm not an amazing trader or anything, but I have started to learn how to be profitable in the last couple months, and it's really exciting to make more in like an hour in the morning than you did at like a day job for a month. So that's kind of the goal here. So the first thing I'll say is Investopedia.com is your best friend here. So if I mention something in here that you don't really understand, just look it up on Investopedia, and I would say go there. They're day trading, the basics, how to get started is probably better than this video, but there's a lot of stuff that maybe they don't mention that I can probably add in just to help you guys like skip ahead on a lot of the mistakes and stuff that I didn't understand when I was learning. So uh, let's go ahead and get into it. First, what is day trading? So basically, we're taking an amount of capital, some money, and getting in and out of positions, shares, fast, and looking for small wins, right? A 10% win is great if you're a day trader or a scalper. A scalper is a couple minutes of a trade, to a medium swing would be like an hour or two, or there's overnight or longer term swings like a couple days or a couple months, right? In day trading, you really want to stay on the short term side of that, scalping or really short swings, like an hour or so. Most of my best trades are 5 or 6 minutes long. And I trade after the market opens at 8:30 until about 10:30 in the morning, and you could even trade less than that or more if you want to, but you don't have to sit there all day. Another benefit of day trading is that you're flat overnight. That means you have no positions or all your cash is still cash. And like a market crash overnight can affect you. And I've learned that trying to sleep with like a big position open is really difficult, because there's a lot of psychological effects of trading that a lot of people don't really think about. So another benefit, impervious to inflation. If your account is just cash, then you're trading the value of those shares every day, no matter what those values are. Whether it's an index or a share, you don't really care. What the market's doing either. If the market goes up, if it goes down, as long as the market's moving, you can make money as a day trader. And that brings me to why I love it is, you're independent. You can own your own time, be your own boss. I really like nerding out about things and tracking them. And the ROI on day trading is quantifiable. If a trade works, you see money. If it doesn't, you lose money. And I just find that really interesting because, just my background, I've worked on a lot of stuff that's not that quantifiable to define success. And so it's exciting to be able to spend time on something and really see yourself get paid back from that time. One of the first questions people ask is, how much money do you need? Not that much. Everyone thinks you need a shitload of money. You do need time, but you can't get good at anything without time. So that's no different than anything else. A couple $100 is plenty to start trading. And while you're saving up that amount of money, you can just do paper trades or fake trades to practice and learn. That's what the smart traders do. If you're looking to get rich quick, don't trade. And then kind of a tease for like what the pros do is called prop trading, where people who have a ton of money that's just sitting there will let traders who are really good but don't have a bunch of capital up front, take a test with like a demo trading account or a paper account, and if they can follow some rules, then they'll say, hey, you're a really great trader, why don't you trade this $100,000 for me and you can keep some of the profits. And that's what most pro traders end up doing, just so you can execute the same strategy just with $1,000 instead of $10, right? So let's go ahead and get into it. The market, shares, stocks, futures, indexes, indices, these are all kind of different terms for the securities we trade. You want to learn kind of what you're focusing on. There's so much to learn, but it's like anything, just go in baby steps and learn one little thing until you understand it, and then go learn the next thing you need to learn. But don't feel like you need to learn everything to be able to day trade. If you can learn how to trade one ticker or one index, that's all you need. Most of the best traders just have one setup, they execute it one or two times a month, and then they're done. And if they've built up so much capital that those trades can be really profitable. The hardest part of trading is having not a lot of capital. So you have to really stick to the discipline and strategy rules when you're trading with like a $500 account, because you need to learn that discipline once you do grow that to a bigger account or get to trade a bigger account through a prop firm, something like that. A share is just the name of a stock, one unit of a stock, right? So a share of Apple is one share, one piece, one stock of Apple. And ticker is kind of the short name. So Apple is APPL, Tesla is TSLA, and Facebook now is Meta for some reason, because they changed their company name to Meta. Microsoft is MSFT, stuff like that. You'll get to learn those pretty quick. We'll get into some of that stuff later. You can day trade crypto. I have never done that. I'm not really interested in doing that, but it's not impossible. Lots of people do it. So the kind of trading I do really applies to any market and any security or trading instrument. So it's totally possible to day trade crypto. I trade the S&P 500, which tracks, basically it's made up of all the top, I think it's the top 500 stocks in the US, and that they rotate that out. So if a company's not doing well, they'll take it out. Or if a company moves beyond another company that's in the bottom, then they'll put that company in, and like the biggest stock in that is Apple. It's like 6 or 7%. So people invest in the S&P 500 or SPX to kind of track the market and not have to pick the winners. Really, you can just kind of invest in the market by investing in the SPX 500 or the S&P 500. QQQ is another example of an index that it just has tech stocks like Tesla and Apple and Google, but it doesn't really expose you to like the Goldman Sachs or the Bank of America or those sorts of tickers. I personally now in the last couple months trade futures. I started in options, and options are really complex, and I realized it was like a variable that was just making it way harder for me. I'm just putting all that on hold for now. You can make a lot with options, but they're just so risky and really hard to get right. Futures are basically contracts that kind of track the S&P. I trade ES. It's called the E-mini S&P index futures. This is the micro version. It's MES, but it's all the same number. So you look at ES. I'm on TradingView here, and just some notes from a trade earlier today. And you kind of learn this number of, this kind of tracks where the stock market is overall, generally with the S&P 500. And you just trade a contract or a lot of futures. So you're literally just trading the price. You'll buy at 38.08 and then you'd sell at 38.20, or you would sell one at 3800 and then buy it back cheaper at 37.84. That's how you make money with trading futures. And that's just a very oversimplification. We'll get into that later. This is just a quick addendum here I'm inserting about futures. I meant to mention the tax benefits are huge on futures. So when you're day trading, you get taxed the short-term capital gains tax, 30%. So if you make $100, you have to pay the government $30. If you trade futures, or there are other instruments that do this as well, but with futures, you're taxed at 60% of your gain is taxed at the long-term capital gains tax, which is over a year, you only charge 15%. And then 40% is short-term capital gains tax. So there are big tax benefits to trading futures as well. Doesn't seem like big numbers, but they will add up, especially when you start making money. Brokers. So brokers are basically the institutions that let you trade. Kind of like a bank, but they help you execute trades. And a lot of them have a lot of their charts. I'm on something called TradingView right now, and it's how I look at tickers and execute trades with my broker, because it's you can built in or connect it and execute it all in one, which I really like. But so there's kind of just a few things to think about when you're looking at a broker: margin or cash account. So if you're going to day trade and you have less than $25,000 and you're not going to trade futures, you should just open a cash account. you can make an unlimited number of day trades with a cash account, but you're only allowed to trade the buying power you have. So if you have $1,000, once you've bought $1,000 worth of shares and traded them for that day, your buying power will be zero until the next day when it resets, and you've sold all those. So your buying power is really limited with a cash account, but that's a good thing for beginners because then you can't overtrade. And leverage comes into play with margin accounts. So with minimum 25,000, or if you're just trading futures, this is a benefit of futures, $250. It doesn't matter. You can trade futures as much as you want. But if you are trading anything else except crypto, so if you're trading stocks, basically, you have to have $25,000 to do an unlimited number of day trades. But with futures, you don't. So there's the PDT rule. That's pattern day trading. And if you're on a margin account under 25,000, you can't make more than 3 round trip trades in 5 days, which means you buy and sell. That's a round trip. So you couldn't buy something and sell it more than 3 times all in the same day over a 5-day period. Real complicated, but you can just avoid that really if you're trading futures. Commissions are how the brokers make money. Every time you execute a trade, they charge you a small fee, and that stuff does matter. A broker that offers free or really cheap commissions, it may not seem like a lot when you don't have a bunch of capital, but when you have a lot of capital, it's going to add up. So just go ahead and get in your mind of trying to trade with the cheapest commission broker that you feel comfortable with trading. The next part of that is what broker I use. I use TradingView, and it is really great. I use it to trade futures. I can execute within TradingView, which we're going to get into later, but TradingView is, I love the user interface here. It's just a really easy, customizable way to look at the candles and charts and share prices and stuff like that. And if that doesn't make sense, we'll get there. So, next, the kind of trading I do is based on price action or technical analysis. And that's just the charts. So we'll look at, this is TradingView here. I'm looking at, this is that ES, the SPX futures, but we'll just look at Tesla just so we're looking at a stock to make it make sense. This is a candlestick chart, and red is down, green is up. And there are a couple of different components of candles, but we'll get to that in a minute. So a lot of the benefits of TradingView is, you can set alerts, like when a stock crosses a certain price range. You could draw a line to help with your analysis, or measure a position with something called the position tool. There's just a lot of ways to really figure out a trade that looks really kind of pleasing and helps it simplify, or helps simplify it for you on TradingView. So the most important elements of price action and trading and technical analysis is just simply the price, which is the candles, and the volume, which is how many people are buying and selling in that period. Each candle represents a different period in time. So this is a 15-minute chart. So every candle represents 15 minutes. And they mean different things. With the thick part is the body, and then the little line is called the wick. And I've got this up over here to kind of show you what that looks like. Here's kind of a simple breakdown of candle. And the thin part is the wick here. So on a green or an up candle, the bottom of the thick part of the body is where the candle opened. And then the high of that candle is the top of the wick, and where the candle closed or the period ended is the close, the top of the body. This would be the low. So the candle opened at this price. It could have shot up to here and then shot down here and then came back up and went here. You'll see candles move really differently. And then red is, or a down candle is the exact opposite. And back to my notes here, the next part of candles are some of the nomenclature. Let me just mention long or bullish position or thesis. If you're long, your thesis is that the share price is going to go up of the security you're trading. If you're short or bearish, then you think it's going to go down. So bullish is up, bearish is down. Long is up, short is down. And you can make money either way. And literally all you need to trade is the price and the volume, and then look for what's called support and resistance levels. And basically all trading is based on group psychology, and this is a really simplification of it, but let's look at a 1-day chart. So every candle is 1 day. You can see, even if you have no idea what any of this means, you see areas where there's, I call it consternation, but there's chop. I call it chop if it's up and down, up and down. And these levels start to mean things to you as a trader, and you start looking at them a little bit closer. So I call it, everyone calls it support and resistance. So a level above the current price of the share is called a level of resistance. And it's where, so I'm going to put a line there. I'm just hitting Option H for shortcut on TradingView. But so I like to put a line there. Let me make that a little brighter so that you can see it. So put a line there. We know the price tested that level a couple times. And let's look for another. So here and here, here, boom. Okay, so that's a level. So these are levels where buyers and sellers reacted to that price in a certain specific way. When the price got here, they sold, and the price came back down. Here's a good example of one where a price respected a level. And so these are points of resistance where once the price goes up and hits that level, it reacts to it. And most of the time, it'll react the same way it has before. But the time that it doesn't, it's going to pop through. And that's basically trading in a nutshell. Is you find those areas of interest or chop, and then you play either side of that. So if I know this level is coming down to there's a couple touches over here. This is really simplified. Definitely Investopedia and dig in on YouTube on support and resistance to get better at this. But I know that when the price comes back down to this level, it's going to slow down and think about the direction it's going. And it's either going to bounce real hard off of it, or it's going to chop around a little bit and then drop under. So what I'm going to do when that happens to take a trade is say, okay, when Tesla, when Tesla gets back down to 182, I'm going to wait for 181 to go short and play a bearish play downside, or I'm going to let it go back over 184 and play it back to the upside towards this other resistance point. So this would be a bounce off support. Once price goes through this line, it changes from support to resistance or resistance to support. So if the price went above this level, it would now be a support level. So they're the same levels, they just change in context based on direction. So as for volume, this volume candle stack down here, these are just elements of TradingView. They're called indicators, and you can get into that by searching for volume. And there's a whole world of this that is kind of a little too advanced for a brand new trader, but you'll learn it as you start playing with TradingView. Volume shows market participation. Higher volume on a candle indicates kind of more probability that it's the trending direction, right? So let's look at an example here. When this green candle here got really small and the volume was really low, we thought, okay, it's starting to think about where it's going. And then the next couple candles kind of did the same, but then once we got to this big candle, this move down with a lot of volume shows you market participation and kind of confirms the direction of a trend. So bringing up trends is basically really simple patterns that the price of a stock is in. So let me just clear all these. So a trend would be, there's a lot of different ways to do it, but it's basically a sort of channel that the price is in, right? And the great thing about price action trading is you're just kind of ignoring everything else, the fundamentals of the trade of the business. You don't care what Tesla's doing, and you can kind of look at news and kind of predict a possible move on a play. Like if Elon says something stupid, then Tesla sometimes reacts to that. But if you just ignore everything and play the chart, you go, okay, well, what's the most probable direction for this to go is like probably come down here and test the bottom of this channel. Okay. So that's kind of how charts work. And if you see a lot of this chop, you want to avoid that. Let the price work itself out. You don't have to predict where it's going. Just wait for it to break one of those chop areas and ride that. 52-week highs and lows are pretty important where, depending on what you're trading. But with day trading, you're worried about the last couple days high and low. You're not worried about what happened a year ago because you're focused on trading the time frame that you're trading, right? So 1-day chart is pretty slow. It's a lower time frame, and a higher time frame that I trade on would be like a 5-minute chart. So, I'm making trades and decisions based on kind of 5-minute directions, but I use that 1-day chart. You can just type in 1D for 1 day and hit enter. I use this 1-day chart and those levels to kind of guide those 5-minute candle plays. So I'll set my levels on the 1-day chart and go to 5 minutes and know, okay, yeah, see, let's wait until we break, that level was here, I think. And then, so I'm not going to mess with any of this chop. I'm going to wait till we break one of these levels and play that direction instead of just trying to guess and all this choppy noise, right? Intraday is what happens during the day. But time frame confluence is a big part of time frames. So if something is if a share is heading in a direction on the 1-day chart, it's heading down, that would be in a downtrend. So if you're looking at the 15-minute chart, okay, and it's interesting how much these levels respect on like the different time frames too. You can already see on the 15-minute chart, it definitely respected that same level. You want to kind of base your plans and trading on the lower, longer time frames. So look at those levels on the 1-day or the 1-week chart, and then those levels, even on intraday plays, will have reactions. That's all we're playing is all we need is a little bit of movement with a few points, right? So longer time frames to set the levels, shorter time frames to play the trades. Make sure I'm not skipping anything here. So there, kind of another element is called candle patterns or chart patterns, and flags or wedges. A lot of people call them a lot of different things. They're kind of subjective. And a kind of joke about this is that technical analysis is basically astrology for men, and that's fine. Maybe that's right. But you don't need a ton of this, right? It would help to maybe understand this is a bear flag. So when a price is kind of at a low here and chops around a little bit in a tight channel, once it breaks under that channel, it tends to move downward. But I find a lot of these are really subjective. Let me see if I can try and find one here. Okay, so here's a good one. So I'm going to get my brush here. So here's a downward move, tight channel, broke down, bear flag. So if you're playing a bear flag, you just wait for this channel to break down, and you would buy here or sell, go short for a downside position here, and use your stop loss as here. So enter here and try to profit down here before it comes back up over here. Is a real simplified version of that. Back to my notes. So back to indicators. There's a myriad of insane indicators. So this is just a default chart right here that I use, and I've kind of changed the colors just because that's what I do. I'll show you what my setup generally looks like. I like gray and green, and then I hide my volume. And I actually have a strategy where I play um, based on the opening range. So every morning I play actually micro futures, which is just the smaller version of ES. More later. Basically, every morning I wait for the first 15 minutes after market opens at 8:30. I set that high and low, and then I play either side of that high and low. And I've kind of coded these entry and exit signals based on my own parameters. And that's, it sounds like too good to be true. Oh, I could just get this thing and then buy when it says buy and sell when it says sell. But there's so many other factors that it's almost impossible. You'd have to know a lot of other things. But I've helped simplify it for myself because I know this strategy and I know when to enter and exit on my own. So another maybe an indicator worth checking out for a newbie is called an EMA, or an exponential moving average. And so these are just lines based on any period of time that show you basically the average price over the last number of periods. And if the price is above that moving average, like this purple line is a 200 EMA right now, the trend is generally up, and vice versa. If it's under, the trend is down. A lot of people play, I'm going to share a real simple strategy here to do on your test trades if you start paper trading, right, which is taking fake trades. You can do it right in here in TradingView. They have you can log into your own broker. I trade with my broker TraderVate in TradingView, but you could also just click Connect Paper Trading, and they'll give you, you can set the fake amount you have and do trade, buy or sell. That's a really good way to practice. So this very simple strategy to test and just help you learn is instead of trying to guess what the candles are doing, which you should never do, a simple strategy: the golden cross or the death cross. So you take the 50 EMA, I'll put this back on, and the 200. So 50 is orange and purple is 200. When the 50 goes below, and this is a 5-minute chart, so this is going to be a little, let's look at the 1-day chart. It'll be a little easier, and you can apply this to any time frame, but this is just going to help. Let's look at Tesla. So whenever this orange line crosses the purple line, you would buy. That's a bullish entry signal. Then when it breaks back under the 50, you'd sell. So Tesla's pretty young. We need for a day. Let's look at like the 1 hour. Here we go. Let me turn off. Yeah, okay, so when we go over, get the brush here. Brush, boom. Okay, so on this candle, when the price crosses with the 50 over the 200, you would enter along and sell when it comes back down and touches. That would be your stop out, but you'd really want to take profit before that up here, and vice versa. So once the price goes under here, you would enter. And so this, if you bought this, you could get all the way up to here. And if you sold this price, I mean, look how far it goes before it even touches. That's a lot. I mean, 270 down to 200. So if you were selling, you would have made, a lot of money buying it back cheaper. With futures, I just think in futures, so if I had bought futures up here and sold it down here, that would have been a heck of a win, right? And this sort of strategy is a good example that can apply to any type of trading, any type of chart, and there are a bajillion other strategies you can learn. I would warn you, do not get too involved in strategies. The only things that matter: price, volume. That's basically the key. So, you could look at these and say, okay, when the price crosses and volume is higher, it's probably a good move. But when it crosses and the volume is lower, it's probably a fake out move. And here's the thing, the market is just a computer that doesn't give a crap about you. You can't control the outcome. You're never going to guess it every time. All we're doing is playing the probabilities over time. So let me just talk a little bit about how to enter and exit trades. If you're trading futures, I'm just going to talk about futures specifically because they are a little confusing for newbies and for me. When you're buying the price of a contract, so I'm in my paper trading here, so I don't accidentally buy anything real. Or when you're going to take a trade, you decide, okay, when the price crosses here, yada yada yada, I'm going to buy. You click these little arrows over here to the right, and you can say, okay, let's buy. I'm going to buy 5 MES contracts at the current price. That would be a market order. Whatever it is, current market price is a market order. A limit order is where you set a price, and if that price hits, your order will submit and execute. So if I say, okay, I want to wait till the price is at 38.30, then I'll change my limit order to 38.30 and hit buy. Nope, that's not right. Let me close that. Stop order. Stop order is a price has to be crossed. So limit is the lowest price that you'll execute at. So if you want to set a limit order, that would be, if price drops down and then I want to buy at that price, trying to get it a little cheaper. Or a stop order is, okay, I want to buy at this level. There it is. Yep. So once price hits this level, I would buy. And you can click and drag these on TradingView. There's a way to set it where you don't have to keep clicking, but it's really interesting and simple way to execute trades here. You can do this paper trading right now for free. And then to set your stops, so once I bought this, I would say, okay, let's do a sell at a limit. So once we get there, it'll sell that contract. And you could also do a stop loss order where, okay, if the trade doesn't work, then it'll protect me from this huge move down. So basically this sort of trade, your take profit would be up here, this sell limit, and this is your stop loss. So I'd say, okay, I'm going to risk, once I'm at 38.30, I'm going to risk 30 points to 3,800 to try to make 50 points. And that's really how trading works. It's not going to work every time. It's just never going to work every time. You're going to take losses. So just think in terms of series of trades, right? It's always important to have that stop loss set, right? So let's see what happens when one executes, right? Because futures are a little different. So let me move the stop to, I'm just going to move the stop so it'll execute. Oh, won't let me. Okay. Okay, it looks like this price is maybe going to hit here. Down to the 1 minute chart. Let's see, watch it reject. It is rejecting. So this is just a 1 minute chart, and you can lose all day watching this if you're not careful. Boom. Okay, so it entered, right? Here's how much I've lost so far in my paper account, right? So this is fake. So okay, it's moving down. Uh-oh. Let me move my stop up because I want to keep it above that 50 EMA line, right? Okay, so I'm going to play this a little tighter just to kind of give the example here. All right, we're clearly rejecting this level, this 38.20 level. This is a reject of a level. This is probably a resistance level. I just haven't looked at it right today. But so, okay, I want to stop out before we get into this area and get real far down. So once the price goes down here, it'll just auto sell that, and I'll take a loss. Cool, lost 75 bucks or whatever it actually is, no big deal. Well, maybe. This is how it goes. This is a good microcosm of trading. Boom. Okay, so it exited, no big deal. And it's like, okay, well, shoot, I guess it's going down. All right, so let me sell. This is how you do short side or bearish moves. You sell to open. And it's just, the orders are based on directionality. If you buy one, all you can do is sell it, is the next option. So if you sell one, all you can do is buy it. So when you're selling to the downside, you sell it at a higher price and then buy it back at a lower price, so it's, you make that money. Every trade, there's somebody on the other side that is losing if you're winning, and vice versa. You know, you're not playing a computer here. Keep that in mind. And you're just trying to find a win over a series of trades. So, oh, now I'm just chasing. Oh, it's going to move down. Maybe not. Maybe. See this area of chop zone? It makes sense for it to kind of bounce back up, right? So these sort of 1 minute moves are going to drive you crazy. You need to have a real specific strategy of every time X, Y, and Z happen, I'm going to enter a trade and wait for that to happen instead of just taking trades like randomly like this. Okay, so I'm going to set my take profit here. So I'll buy it back at a limit down here and wait for that to happen. And then I'll sell it at a stop here. Sorry, sell at a limit here. If it goes up, that's going to protect my capital. I'll only lose like $100 instead of it losing 1,000 and going up this way. I'll just let that go. So the next big part of trading is risk management. Okay, I would say it's the most important part. You know, without managing your risk, you're just gambling aimlessly. That is very important. The goal of trading, and it is gambling, is to play like you're the casino. We're taking advantage of the probabilities. Okay, we're the one buying the slot machine and putting it out on the floor. All right, we know over 1,000 times someone pulls that lever, 990 of those times, we're going to keep that money. That's how trading works. Controlling risk. Prevent yourself from the big losses, right? You'll thank yourself later. I know I'm just reading my slides here, but there's only 5 things that can happen when you enter a trade. You can get a small win, you can get a big win, you can go break even, sell at your entry price. You can have a small loss. Those are all fine. That's all you ever want to happen. The big loss is what you don't want to happen. Okay, if you can prevent big losses in trading from day one, you can make money trading. Part of trading is taking losses. So if you can take small ones well, you can trade really well. Think systematically. So we're not trying to make $1 million in one day. We're not trying to make our month's rent in one day on trading. We're looking for our setup, executing that setup every time it happens, and over 100 times or 50 times or 200 times, you're profitable. Okay, so it's eating an elephant one bite at a time here. You're not going to get rich fast. Trading is how you get rich slow. It's really important to know where you're going to enter and exit before you take a trade. Otherwise, you're just guessing or reacting to candles. The astrology for men, you could be right, or it's so subjective. You could always bias yourself in a different way. So the key to trading is knowing if X and Y happen, I'm gonna do Z, and then here's where I'm getting in or getting out, and that's it. And know that before you take the trade, and stick to that before you take the trade. Pretty much all of the times I've lost is because I screwed up and ignored my plan or didn't have that plan. And then when the real money's on the line and the candles are chopping up and down like this, like you can see it happening in this trade, I totally got faked out here, right? So this was 2 losses in a row that just were no point because I just jumped into a pointless trade, right? The actual trade is waiting for it to break that line, and this is when you buy, or this is when you buy, not just up here randomly. You know what I mean? Because you'll just get shaken out. That's kind of how risk management works, right? Is you have to control what you can control, and that is your entry and your exit. You cannot control what the market does. And we don't care what the market does. The next part of risk management is sizing, and this is going to come back into play with psychology. But if you're trading with $5,000 account, you're not putting $5,000 every trade. It's just stupid. you know you're going to lose sometimes, and you need to play trades the right size that you can stomach those losses while you hold on for the wins. The goal is to survive to live another day, make it to the next day to trade. So having the plan and knowing, okay, I'm risking 1% of my account on every trade, and sticking to it is really going to help you become a profitable trader. I have a little position sizing cheat sheet here that I made a while ago. Let me zoom in here. So these are just example account sizes. If you have an account of $500 or $1,000, you want to keep most of that in cash, just as a safety net. You don't want to put all $500 in any one play, right? Because you can lose any play. You have no control over the outcome of one play. They're all random. And you want to risk a manageable amount. So these numbers seem really small, but once you start getting some serious capital, you want to keep them small, and having these good habits on percentage size of plays and risk is really important. I think with a smaller account, it's really hard because these numbers are kind of annoying and seem worthless, but they're not, because you're building that those good habits, right? To trading, a good trader can execute a trade no matter what the amount of capital is. If it's $5,000 or if it's $1 million, the strategy is essentially the same. It's just that real money is different, and that can affect you, right? So that's why we want to keep these numbers small. Basically, what this means is that on a $500 account, you would take a trade that costs $100, and you would risk, if you're doing 3%, $15, right? And so on and so forth. So let me show you how futures work. Every futures contract, I trade the micro futures. It's a micro version of the E-mini. The S&P 500, which is the futures version of that, is ES, and MES is the micro version of that. So on TradingView, you would type in MES, click on my watch list here. Let's look at MES. I'm still on it. Okay. Yeah. So I'm just going to close this trade because it looks like it's going to be off. And I close these. Make sure you close these too, so you don't actually buy and go the opposite direction. Never leave anything running that you're not watching immediately, or watching like a hawk, right? So on MES, every 1 point is worth $5. And this is why I really like futures, is because like with options, there's so much going on. The Greeks and all this stuff, it's so complicated. And you can look it up and learn it, but I think until you're a really profitable, disciplined trader with futures or with shares, there's no point. And if you're making money with that, why switch, right? So all you need on Tradevate to buy a futures micro contract, the one MES contract, or a lot, is $55. $55. And look at what this can get you. So one share of Apple, I'm just comparing here, is $137 today, I think. So I just went with that. Every time these go up 1 point, on MES, you would make $5. On Apple, you make $1. 1 point is $1 on Apple, but on a futures contract, it's $5. Every 25 cents, are called ticks, is $1.25. And on ES, this is $50. ES contracts can get scary if you have a couple, because that stuff moves fast, and it's like, there's leverage involved here. So you're controlling a much larger amount of money, but you're controlling your risk. So you're really only risking, you know how much you're risking, and you'll prevent yourself from going under zero if you're following the right rules. And you can get into that through the broker's education. But basically, never risk more than is in your account, and have that stop loss set, and you'll be fine. So if you have one contract, or have 10 contracts of MES, for that cost, you have to have $550 in your account, but you wouldn't, you'd want to really have like 5,000, because you only want to play like 10% size or something like that, right? But basically, $550 on MES, the same size move, 1 point on Apple, with 10 shares, that would cost you $1,300. You would make $10. But on MES, you make $50, right? 5 point gain, you make $25 on one contract, and you would only make $5 on Apple, right? And so on. It kind of makes sense to trade futures if you don't have a lot of capital. There are people, the hedge funds and the bajillionaires, they're trading like 100,000 shares of Apple, where you make $1 on 100,000 shares. Okay, you know what I mean? Like, you're making pretty good money, but we're not there yet. And go back to my notes. So you want to base, I'm going to talk about probabilities and series of trades now. You want to base your trading on probabilities that you develop from a strategy. A strategy would be like that 50 over 200 EMA cross. My strategy is, I call it the orb, the opening range breakout. And I've developed this strategy, and I've gone back and what's called back tested, where I've gone and looked at the historical data on TradingView for almost a year's worth now, and seen, okay, on this day, October 20th, 2022, well, that's when I published it, but when I made this chart, but that the day is, okay, so this is September 13th. September 13th, 2022, I saw my signal hit under my orb, and here's how far the price went before it hit my stop loss. And this is on SPY. It's like the mini version of SPX. And I'm just learning how the backtest data works. But another element is called R multiple. And this is kind of, it's a little complex. Basically, you want to control this R multiple. That's going to be what you risk every trade is R. And you want to keep that number the same. You want to win more than you lose on number of trades, and profit. You want to try to make more on trades you win and lose less on trades you lose. And that's your profit factor or profit ratio, where, on this, I have 216 times my trade signaled. 182 of those, I made more than I was risking. 84%. This is really good. And really, this is back testing. It's not perfect, right? Executing a trade live is much harder. So I expect this to be around 70% win rate, which is still fine. So another way to look at it is, okay, so on a $4,000 account, I'm risking 6% of my account, $250 on every trade, and I'm at an 83% win rate. If I average 1 R return, so if I make that $250 back every time I win over 100 trades, this account will turn into at least 16,500. And I want to make a note here. I'm not accounting for the size of the account at each entry. You are supposed to keep that risk percentage. If you're risking 1% of your account, say 5 trades down the line, you're at $4,700, then you risk 1% of $4,700, not 1% of the original 4,000. If I make 1.5 times that 250 every 100 trades, the account would be at 26,000. If you make 3, you'd be at 58. These are big numbers, and these are really hard to get, right? You, even having a 0.7 R return and a 70% win rate is still profitable in trading, right? So you need to think in terms of probabilities over a system of trades. Another important sheet I really like looking at is this probability of X consecutive losing trades within a 100 trade sequence. So this left is your win rate, so how many times you win out of 100 trades. And this number in the middle is how many losers in a row. So with a 50% win rate, you have a 95% chance to see 5 losers in a row. Even if you have an 80% win rate, there's still a 50% chance you're going to see 3 losers in a row and on down, right? So this brings me back to risk. If you're risking 20% of your account every trade and you run into this 5 losers in a row, bye-bye account. But if you're risking 1% of account or 5% of your account and you run into 5 losers in a row, that's only 5% or 25% of your account gone. That's how you protect your capital. Risk small. And it's going to feel small at first when you're winning, but small gains add up. We're trying to get base hits. We're trying to beat Ichiro. Back to my notes here. Okay, so let's just talk a little bit about psychology here. There's a really great book called Trading in the Zone. And I'll share a link to it if you'd like, but some of the key takeaways from that and just some other stuff I've learned. We have no idea why the market moves the way it does. We don't care. All we're doing is looking at the chart and executing a series of trades based on a setup, a probability, an edge on that chart. Outcome of any one trade is random. You can't control it. There's almost no skill in executing a winning trade. The skill of a trader is risk management, psychology, and discipline. Trading is 90% psychology, 10% execution. and I'm not going to read all these out, but it is important to think about these. Protect your capital and take what the market's giving you. Just focus on one trade strategy until you can really execute it or learn enough to realize, hey, this is not the trade strategy for me. The market's not going away, so it's okay to step back if you don't feel good, or if you have to work a different job that day. It's okay to not trade that day. You don't have to trade every day. Don't force the trades. This is probably the biggest important thing. Don't force trades. Wait for the market to come to you. And that leads into this next point. No setup, no trade. Patience pays in trading. Okay, less is more. Better, high quality setups. Your strategy is better than just jumping in a bunch of random trades. It's also important to pay yourself. Douglas, in his book Trading in the Zone, mentions the plateau method, where you cash out half your gains, basically. So if you have a $5,000 account, you make $5,000, so you get to $10,000, cash out $2,500, start over with $7,500 in your trading account, so on and so forth. It's a good way because a lot of times people will make a lot of money in a day, and I've done this a bunch, where I made like $4,000 in a day, and then I gave away $2,500 of it. Okay, I still made $1,500 that day, but I gave away a shitload of profits. Take profit when you see it and pay yourself with it, or you're just going to blow it. FOMO is a big thing, fear of missing out. So don't just stare at the charts all day and hope that your trade's going to turn around. You can't control that trade. You shouldn't be that connected to that trade. Don't let any one trade affect you, and that comes back to the emotions. Size small enough that the trade doesn't bother you when you lose, because should feel like paper trading. Paper trading, the fake trading, is very easy compared to live trading. Once you get real money in the game, you'll understand the emotional difference there. But if you play small enough where a big win doesn't excite you too much and a loss doesn't bother you too much or at all, then you can really be a good trader, because we're just executing a system here. The money isn't real. It doesn't matter. It's just a number, and it's not real till you cash it out to your bank account. Small account helps with the discipline because it's so much harder. If you can't make $10 a week with a $250 account, why would you try to do it with a $25,000 account and try to make 1,000, right? You're just going to lose it. Ownership of your own strategy instead of just blindly following somebody else's is really important. I didn't really start making money trading until I owned my own strategy and plan instead of just trying to follow somebody else's. I was really hot, like at the end of July, from July 5th to mid-September, I took $2,500 to $15,000. And I blew it back down to like 11 and then cashed out 5. And then I just trade with a little of a $5,000 account now, basically, and cash out gains until I get to a bigger number. And then I'm going to try something a little smaller, play size with bigger capital and stuff. But don't stare at the charts all day. Something really easy I do is called the point and call method. Is you speak aloud your plan before you enter a trade, write it down too. So I say, all right, I'm going to buy MES at 37.90. I'm going to sell it to take profit at 3800, or my stop loss is going to be 37.80, and then I execute that instead of just moving real fast and not thinking through it. I mentioned this before, stick to one instrument. The grass is always greener, that's true. Zoom out. This is a really big, important element of trading and life in general. If you're looking at like the 1 minute chart, look at all this noise on the 1 minute chart. Everyone is going to get faked out with the way this moves. Let's look at a 1 hour chart. This is the same amount of time. So if you could be patient instead of trying to jump into trades and wait for that hour candle to make a move over a number instead of trying to guess where these little tiny ones are going all the time, that's how you're going to profit in trading. And if you're not understanding what the market structure is, keep zooming out. Like, okay, the 1 minute's crazy. Let me look at the 15. Now that makes a little sense, but let me look at the 1 hour. Oh, okay, cool. Now I'm like, no, the market's trending up and that's where it's going. Okay. Journaling is really important. So I actually have I write down basically every day what my results and thoughts and feelings are, and kind of go back and look at them at the end of the week and see why I took a trade or why I exited a trade or where I screwed up, and review. And that once you gather this data, like with back testing a strategy or just testing something out, it starts hitting you in the face of, oh my God, 50 times, if I had just taken $10 instead of hoping for 20, I would have made $400, and instead I'm down $200. You know what I mean? Something like that. So looking at your data is very important, and especially the emotional side. Like, oh, I got into a fight with my wife this morning, or the dog was making me angry. Sometimes that'll affect you and you'll make a bad trade. Unless you're really calm and clear with your mind, don't trade. Don't force it. Just take the day off. That's totally fine. If you need to trade to make money immediately, it's not going to go well. You have to go into the process with the possibility, but not the expectation. So kind of the last part of this video is the mistakes I've made. Over trading is huge. Just do 1 or 2 trades a day. You do not need to do more than that. Track every single aspect of every trade. Have a plan. I've said a lot of this before. Don't jump into trades randomly. Don't try everything in the world. Learn one little thing, get really good at that, and then maybe move on if you feel like you need to. If you see green, take it. Take small profits. This holding on for bigger gains has really burned me this year, and because a couple of them I've made huge wins, and then you fly too close to the sun like that, and then you're like hoping for it every other trade, and you're just ignoring the reality of, man, if you can just make $50 a day or $100 a day, that turns into big money instead of like once every 10 days make $600. And the goal there for me, I think about this as a lot, is like I'd rather be a little annoyed I didn't make more if something does take off after I sell. I'd rather be that annoyed than mad that I lost money on something. And another key to this is after you exit a trade, close your laptop, leave, don't look, okay? Don't stalk your ex on Facebook. Just move on, because all you're doing is looking for the next trade, obsessing over the money you could have made that day if you held is just going to screw you up. But if you look at it objectively later or the next day or that weekend or something when you're going over your trades, you can go, oh, okay, the next time this candle does this or this or that, and base it over a series of trades, not just one time, because candles will fake you out. Then you can change your system, but don't change your system in the moment. Over analysis, I've always done this, but don't take input from too many sources. Learn how to set your own support and resistance levels. Learn how to read volume, learn the candle structure and patterns. Keep it simple. Just pick one thing. I suggest futures. Micro contracts are really cheap. And avoid the alert services that ask you to pay for their stock alerts, or it's almost impossible to follow those unless you have like a shitload of money or you're an already really good trader. It's just going to teach you bad habits and teach you and get you to FOMO. There are a few really good services. I really like my buddy Panda Options that have a really good, kind of onboard and education process about risk management. So, they're not all bad or anything like that, but just know that there's no silver bullet. The only technical analysis I include in my strategy is from this guy. I like his name's Adam Mancini, and he's Twitter guy. He's a full-time futures trader. I've been following him for about 2 years, and every day he posts really great analysis on where the ES price is and what it could do. And he has a lot of great nuggets on how trading should work too, and he replies to people. I just kind of look at his TA for the day and include it in my strategy that I've already laid out. Big element. Yeah, so you could just see like there are other people like this, but I just really like this guy. He makes it simple every day. He's looking at the ticker that I'm looking at. So, and he's clearly successful at trading it. And yeah, I think that's about it. So tight hour here, but that kind of breaks down everything. And what if I said something you didn't understand, Investopedia or ask me in the comments on this video, and dig into videos on YouTube that are like way more in depth on that specific issue. So hope this helps. So thanks for watching the video. I'm going to leave a PayPal link in the description if you want to throw me a few bones, just a tip jar, no pressure. I'm also working on a video on more in depth on most of this stuff and maybe some shorter videos that focus more specifically. So hit me in the comments with anything that you'd like me to cover. Definitely hit the like and subscribe. I really have fun making these videos, so I think I'm going to make some more. And I also have one coming on my orb indicator I'm going to offer as a subscription once it's done. So that'll be fun too, and I'll go over how to trade trade that. So anyway, thanks for watching. Like and subscribe, all that. See you next time.